Welcome to the Professional Edge. My name's Sean Todd, tax attorney, CPA, and certified financial planner, host here on the Professional Edge for going on 5 years. What we're talking about now is do not fight the Fed. When I was in grad school, I had an economics professor. He was unbelievable, always smoked the cigarette, and he would put the cigarette out on the chalkboard. And he would look out into the class, and I never will forget these statements. He said, if there's only one thing you take away from this class, it is don't fight the Fed. And then he would go into this lecture and draw these graphs of macroeconomics and how the impact was and the change in the demand of the supply curve, and then a shift in the supply curve and the shift in the demand curve. And then all of a sudden he would take a big piece of chalk and mark a big X, and he says, here's where we are now, and then here's where we're going to be. And he said, that right there is how you don't fight the Fed. And I never will forget that. It was a very impactful class, very instructive professor. I owe a lot to him on that. And that's what I'm trying to bring to you as a listener here on the Professional Edge, is you can't fight the Fed. The Fed was very accommodative the past 4 years when we've had this zero rate environment. And yes, it spurred a whole bunch of demand. When mortgage rates go to less than 3% on a 30-year mortgage, that's what I call free money. So when you have that free money coming along, then you spur a lot of demand, and that's where housing went crazy. And then you bring it down one more level and you say, okay, with housing, you better have construction workers, you better have roofing materials, you have lumber, and everything else that goes inside, appliance demand, microwaves, stoves, refrigerators, carpeting, wood flooring. It just continues to expand and expand. And that's when everything was great. When you bought a bond, guess what? When the interest rates fall, the bond values went up. So your equities were going up because you were in the home building sector. And lo and behold, then you had your bonds going up too. So it was like nirvana. But then we have changed course. The interest rate environment has changed. We are now in an increasing rate environment. And it is a different animal to invest when interest rates are going up, not when they're coming down. So if you've not made an adjustment within your portfolio and made some moves, here's the wake-up call on the Professional Edge. It's time, or the ship is leaving the port. You need to get back on that ship. So you need to make some changes. If you're not sure where to change and you're just sort of stuck there like a deer in the headlights, you're frozen, then do give our office a call at 877-654-9798. That number again, 877-654-9798. Have a consultation on Zoom or down at the Cunningham Center or up in Atlanta at our office. And that's where we understand what you're trying to accomplish and what you need to do moving forward. And yes, you, the conservative investor, having that rule of 100, take 100, subtract your age. That's the amount you need to have in equities. And then the balance portion should be in, quote, safety and bonds. Well, you got a wake-up call because your bond portfolio fell and your equity side fell. And about the only thing that maintained in value was your cash. But with inflation at record high levels and the price of groceries going up 11 and 15%, and the price of gas hitting almost $4.55 a gallon if you're in California, then that was also a way to lose the purchasing power very safely. So where did you need to go, or where do you need to go? In a rising rate environment, there are certain sectors in which you need to place your accounts and some value in there. And yes, technology has taken a reprieve from the record gains that it's had in that sector. It's okay. It might be a buying opportunity. It might not, depending on your risk tolerance. And that's what we do at Estate Management Counselors. We sit down, evaluate the risk, and also address this sequence of return risk. You are now exposed to that as an investor in this market. So you, on the approach to being in retirement, have your 401k. You don't like opening your statements here recently because of the downturn in the market. And you are now concerned whether you are going to be able to stay on approach to retire in, let's say, 2023, 2024. Well, it's time to have that wake-up call, get an objective opinion, see where you need to replace or reposition those assets, even within your 401k. There are some places that we can move to. And yes, sometimes there's limited selections within that 401k or 403b or 457 plan, whichever your employer offers to you. But it's okay to make those adjustments. They are going to be a non-taxable transaction because it's within that qualified account. And go forward, moving forward. We don't want to, if possible, have you postpone your retirement when you had that dream to be done at 62 or 64, whatever the magic age is for you as a listener here on the Professional Edge. So we accomplish that objective. And yes, are we going to be exactly correct? No, no one is. But we are definitely going to make some decisions and implement that based on the knowledge that is presented with us. So the knowledge that we have is the Fed made a very pointed statement that they will attack this inflation concern and they will wrestle it to the mat. While you, as an investor, that is a warning sign. That is a cannon being loaded with a cannonball and about ready to light the wick to explode the cannon. They've done it at the beginning of 2022. They're going to continue with that. That is the Fed Powell speak this past week. So if you've not done anything, you've been sort of started playing the wait game and not making any adjustments, I'm here to tell you it's past time to make some adjustments within your portfolio. If you're not sure what to do, where to go, do give our office a call at 877-654-9798. That number again, 877-654-9798. So when we say don't fight the Fed, well, the Fed's raising interest rates. So what does that mean across the different sectors? Well, we know that long-term bonds, that's that duration in the bond portfolio, the farther away from that fulcrum you are, the greater impact the rising of interest rates will have on the value of your bond portfolio. They will fall. So again, a 10-year duration bond is going to fall greater in value than a 2-year duration bond. So again, need to analyze what actually is in that bond fund. And the farther away from that fulcrum, get ready for a farther fall in the value of your bonds. Is it temporary? Maybe, maybe not. If they continue to raise interest rates as projected, then your bond value will continue to fall. Now, we all understand that if we have an individual issue in that bond, that value of that bond will also fall until you hold it to maturity. So you say, wow, I hold my own bonds and I really don't understand why they fell in value. Well, because you're not going to be realizing the face value of that bond until it matures, which is 15, maybe even 20 years from now. So that underlying value is going to get adjusted into the market rate of what that bond is actually valued at today. So that's where even holding the individual issues, your bond values have fallen. So again, might want to make a change or make an adjustment within your portfolio. If it's in a taxable account and you've lost some value, it's okay. Take the loss, recognize the loss, or actually realize it, and then we're going to recognize it on your 1040 tax return up to a certain limit imposed by the Internal Revenue Service rules and regulations. And then from that point, we get to carry that capital loss forward or utilize it against capital gains distributions or other gains that you have. It's okay. You may have a piece of investment property and you finally sell it. And now we can utilize these capital losses that you have within your securities portfolio to offset that gain. And that might be some additional monies that you have to start your retirement. So it just depends on you, the listener, on the Professional Edge, what exactly is within your portfolio. Hopefully you're not all invested in the stock market. That's not prudent. And listening here on the Professional Edge, we don't recognize, or we don't want to recognize, that you're fully invested. And yes, as the stock market was great and reaching record highs even up into January 3rd, that individuals become more risky. And that's not the best thing to do. They sort of turn a blind eye, and they love opening their statements as they go up and go up, and they keep putting more and more in and more and more in. And then when the market has an adjustment like it has in 2022, I'm not sure I'm as risky as what I thought I was, because when the market drops by 20% on $1 million portfolio, that's $200,000. That might be twice your annual salary on the decrease in the value. And yes, we all understand that the markets drop a lot quicker than what they do when they go up. So it takes a longer time to recover than it does for a correction or an adjustment in the market. So again, if you don't understand exactly what you need to be doing, do give our office a call at 877-654-9798. That number again, 877-654-9798. And to beat inflation, we put together what I call the bundle. It is your estate plan, your financial plan, and a tax plan to reduce your taxes to the lowest extent possible. That is your legal responsibility to pay the minimum amount of taxes. If you want to be a volunteer, then write a check to the Internal Revenue Service as a volunteer and say, here's some additional tax dollars. I'm not sure you're listening to Professional Edge if you're one of those individuals, but if you want the least amount of taxes to be owed, then do give our office a call or go to thebundle.com. That is EMC, Echo Mary Charlie, thebundle.com. Echo Mary Charlie, thebundle.com. More coming up here on the Professional Edge, how not to fight the Fed. My name's C. Todd, tax attorney, CPA, certified financial planner, host here at the Professional Edge. More coming up. Stay tuned.